Hello, and welcome to episode 2 of our podcast series, Source of Truth, sponsored by our friends at Solo. Today's episode is about the tension between credit decision quality and efficiency. Now, we know how to make great credit decisions. We've known how to do this forever. It's really not that complex. What is complex, and what has been the source of tremendous business value and competitive differentiation over the years, is how to make great credit decisions efficiently. And this is important. Unless you're exclusively going to operate in the commercial lending space, you need to care about efficiency. The only way to make money in consumer and small business lending is to find the right balance between decision quality and decision efficiency. This is why credit reporting and credit scoring have turned into massive industries over the last 30 years. By standardizing on a relatively narrow set of high-calorie inputs into the credit decision-making process, lenders can theoretically make good credit decisions without expending too much time or money, thereby preserving their ROI. But what are the perils of over-standardizing on credit reports and credit scores? That's what I talk about with today's guest, Martin Kleinbard, founder of Granual Fintech, former CFPB staffer, and longtime bank and fintech operator in the lending space. As you will hear, Martin is an even bigger nerd than I am on the history of credit decisioning and credit scoring. I didn't think that was possible. We talk about the lessons that lenders learned after the 2007 mortgage crisis, the importance of a balanced approach to credit risk evaluation, the subtle challenges posed by second-order risks, and how generative AI is going to change all of this in the years to come. Martin is great, this episode is great, and I can't wait for you to hear it. So, without further ado, here is episode 2 of Source of Truth. Martin, thank you for joining me.
Thanks so much, Alex. It's great to be here.
I am delighted to have you back, sir. Couldn't think of a better person for this episode. And where I want to start is a little bit of history, which I know you and I share as sort of an interest. You, for background for the audience, wrote a wonderful research report, how Cashflow data can diffuse the credit score time bomb, which I was proud to publish at Fintech Takes. And in that report, among all the different kind of areas that you talk about, one of the things you spend some time walking through is the history of credit scoring and how in the 1990s, and especially after Fannie and Freddie in 1995, essentially required all mortgage lenders who were selling conforming loans to use the FICO score, how lenders really started to rely on credit scores as a standardized mechanism for predicting defaults. And I was hoping that you could help us understand a little bit of the history behind this in terms of, again, kind of historically before this happened, how lenders made credit decisions, and then how things changed once they started to standardize on using credit scores and credit files, and why they became so enamored with this model of making decisions, which is really kind of what we've been living with really since the early 90s.
Well, first off, Alex, it was a pleasure and an honor to be able to publish that under your banner and with Jason and Prism. So, thank you so much for that opportunity. And it's great to be talking about this again because it just continues to be really timely. And even though it seems like ancient history at the time, it's really not. And, we could be doomed to repeating a lot of these same mistakes if we're not careful. So what happened in 1995, as you alluded to, is that within a few months of each other, Freddie Mac and then Fannie Mae, who together essentially make up the liquidity market for conforming mortgages, they decided to essentially require mortgage originators to pull an applicant's FICO score. At the time, this score, which had been created in 1989 by the Fair Isaac Corporation, it had been tossed around in credit circles. And so some folks in the know knew about it, but it was definitely not something that had been publicized to the general public, and definitely not something that most mortgage originators had known about. And in fact, mortgage originators in general were pretty slow to adopt credit scoring in any form. And so this was a major adjustment, a major sea change for them to say, you have to use this number. And if this 3-digit number falls below a certain number, usually 620, it was essentially buyer beware. And in the initial memo that the Freddie Mac executives put out, which you can still find a copy of, and I have a link to in my paper, they essentially lay out the strategy that is still in practice today, which is if the score is over 660, essentially do everything you would otherwise do to underwrite the loan. So look at their debt to income ratio, look at any historical patterns of debt repayment, and just do everything you would otherwise do. Between 620 and 659, apply a little more care. And then under 620, it was essentially buyer beware, which they didn't explicitly say it up front, but it became de facto and then de jure that we're not going to accept loans under this amount and call them conforming. And so when it's Fannie and Freddie setting those rules for the secondary market and they say buyer beware, that's basically like, we're not going to take those. I mean, whether they got there at first or not, that's essentially the effect. Exactly. And it was actually very prescient that, a longtime real estate columnist in the Washington Post who was syndicated across the country named Kenneth Harney, he said a week after the Freddie announcement, this is going to change the world. And he said, when Freddie speaks, they essentially carry the force of Moses coming down with the commandments. And he was exactly right that this would change the way that all lenders participated in the consumer credit markets and that consumers would participate in the credit markets. And what changed almost overnight was lenders realizing that they didn't necessarily feel like they had to do all of those other checks that they had been doing in the past. And that instead of being a great additive piece, and a great complement to their existing underwriting regime, which had worked very well for several decades, it quickly became a substitute for it. And there are all these quotes, some of which are in that report, from bankers early on saying, like, wow, we had no idea how easily we could start originating loans using this score. And like, you don't even need a W-2. I mean, it's like stuff like right out of The Big Short, except it was way before that. And at the ground level, right? So you're not talking about three levels removed in high finance in the Lehman Brothers towers, right? You're talking like on the ground, right? These mortgage officers, in these small offices, were not making these big salaries, right? Not, the ones like who became like the face of the crisis. But they were the ones on the ground level originating these loans that then got packaged and turned into the CDOs and all that stuff that, we're more familiar with. And those decisions very quickly became hinged on this idea that if we just do what this number says we should do, everything will be fine. And there were markets that sprouted up overnight, like over 100 LTV loans, essentially loans that were for more than the value of the home, were non-existent before 1995. And within 2 years, the market was $2 billion. That's not a coincidence, right? That was because of the fact that FICO made lenders feel confident that, first of all, that loan would get purchased by Fannie and Freddie, and that second of all, it would perform according to this repayment schedule that they had been told was pretty consistent and had been fairly consistent up to that point. Right. So that is a really great explanation. And just to double click on a couple parts of that, right? One is that, we should sort of be clear, like the FICO score and other kind of credit scores built on kind of traditional credit data, they work really well, right? Like they're very useful and they give you a good lens on willingness to repay, past behavior, past performance, which as someone I used to work with described it like that data and the analytics built on it has like a high caloric value for making decisions, right? Like it's very, very useful. But I think the thing that's really interesting in what you describe is this idea that, okay, now we have this standardized tool to do this. And because it works so well, the temptation is to standardize on it and to overuse it and to maybe let some of those other approaches that we were taking in addition to using traditional credit data and credit scores
to let some of those other muscles kind of atrophy, so to speak, right? And like, maybe we're not going to pay quite so much attention to this thing, or, hey, this other aspect that we used to go through for underwriting, I mean, we all know this as borrowers. A lot of the things lenders ask for are just kind of a pain to deal with, right? Like, do you really need me to go get this? It's going to cause friction if I ask the borrower to go back and get this other piece of information. And so there is this sort of tension, and particularly because of the way the mortgage market sort of standardized on credit scoring, it kind of resolved that tension for lenders and was like, nope, we're good if you just use this score. So you mentioned The Big Short. Fast forward us a few years. I mean, obviously we just talked through what the benefits are to lenders in standardizing on one way of looking at credit risk and credit worthiness. Mm-hmm. What are the downsides of maybe over standardizing or overusing that one metric?
Yeah, so I think like the best illustration that I can give is by comparing two cohorts of securitized mortgages, one from 2003 and one from 2007. They were both given the delineation of Alt A. And if that rings a bell, that's because that's one of those buzz terms from the crisis that people realized were getting us into trouble. They were loans that were considered not subprime, so not the riskiest of the risky, but essentially something that was outside the normal bounds of riskiness. And so they were kind of in between the clear prime that conforms to all of the traditional rules and expectations, and the subprime that were clearly high risk. But nonetheless, they both got that same designation. So in theory, they should both carry around the same risk criteria. Okay. Now I'm going to read off a few numbers. Okay. Percent of the of the securitized population that are fixed rate. 2003, 69%, 2007, 42%. Percent with low or no documentation. 2003, 63%, 2007, 81%. So in both those situations, 2007, much riskier than 2003. Percent with introductory interest-only payments. 2003, 16%, 2007, 52%.
Whoa.
Percent allowing negative amortization. 2003, 2%, 2007, 30%. So by all these metrics, right, 2007 significantly riskier than 2003. Yet you might be asking, how did they get the same Alt A designation? Sure. And the answer is there's one metric I have not given you yet, and that is median FICO score, 2003, 710, 2007, 707. So essentially the same. And because the market said, the FICO's is in the low 700s, it decided that FICO's low 700s, and because there were some parts of those loans that were non-conforming, they were just going to say they're all the same, even though obviously the percentages of those were wildly different from those two populations. So I feel like that is the best microcosm that I can give of that mindset of just blinding yourself to all other conditions and saying, well, if the FICO says this is what it is, and over the last 10 years, the historic performance of 707s has been fairly consistent along this, band of confidence, then why do we care if we're loading up more loans with negative amortization and with interest-only payments and low or no doc, et cetera?
Yeah, it's those numbers are really telling, right? And I think that, again, the thing that's interesting here is it's really a misuse of the credit score, right? To ask it to carry all the weight for these other things that it's just really not designed for, to say nothing of the fact that, a lot of these models, right? And this is just like generally true. And this is why lenders, when they're really doing a good job from a credit risk decisioning perspective, tend to take a diversified approach. Is a diversified approach to evaluating a borrower shields you against any one way that you're looking at them being off in case some underlying condition changes, right? And obviously, when we talk about underlying conditions, and you heard this, I think they talk about this in The Big Short, and they talk about this in other sort of literature and sort of coverage of those days. no one defaults on their houses, right? And that was like this sort
That's
of like
the opening
conventional
line. That is the opening line from the movie. And
right. Like who would default on their
Definitely
house?
read the book too, right?
Yeah. And it's like that was the conventional wisdom that was as conventional wisdom as saying the sky is blue. Like who doesn't pay their mortgage? And that was like the underlying confidence along with some of these indicators that just wasn't a good assumption. And to your point, it's not like there weren't other pieces of data that lenders had or could get that wouldn't have helped them distinguish between different, 700s that all otherwise looked very, very similar. So I want to dig into that point because to me, and this is something that you definitely touched on in your report, but I want to sort of pull it apart a little bit more. I think a lot of the issues that we struggle with in this area come down to a trade-off between decision quality and efficiency, right? So if you think about it, and you've worked in lending for a long time, so you know this, like the best credit decisions are made carefully. They treat borrowers as individuals. They take a nuanced approach to understanding each individual, their circumstances, their past performance, why they're getting the loan that they're getting, how the structure and terms of that loan will actually impact their ability to pay it back. Like they take all of those things into consideration and are very, very careful in doing that. The problem is that unless you're making a $500 million commercial loan, the time necessary to make a truly great credit decision is usually not worth the revenue that loan is going to generate on a standalone individual basis, right? So in lending, we've always, I think, tried to kind of strike a good balance between what are all the things we could do theoretically to make a really great decision? What are all the things we would want to know? What's all the data we would want to collect? How would we look at that data? How would we think about it? How would we weigh these different variables against the sort of business imperative, which is to be as efficient as possible in evaluating potential borrowers, which as you scale down from commercial lending to small business lending and small business lending down to consumer lending, you really need to be as efficient as possible in order to get a good ROI, right? And I guess one of the things I'm curious about is in the wake of 2007, 2008, and you talk about this in your report as being a policy success that we had, right, in reaction to the crisis. What are some of the ways that you've seen lenders attempt to improve the quality of their decisions relative to what they were doing in those days without introducing too much more inefficiency back into the process, which obviously is kind of not tolerable for the business of lending?
Yeah, so you bring up a lot of great points. And I think when you think about consumer credit underwriting, right, there's really three pieces. There's ability to repay, willingness to repay, and then product, the product level underwriting, or second order risk, as we'll call it. So FICO only helps with willingness to repay, or credit, or character, or consumer's history of repaying debt. It knows nothing about how much money you make right now. It knows nothing about how much money you have in the bank account, about whether that bank account's been dwindling over time or growing over time, whether your income's been growing over time. It knows none of that information. It just knows, have you repaid your debt? So it's really good on if macro credit conditions stay the same, and if your personal condition stays relatively similar, it's spot on. But of course, those other two conditions don't always hold. So ability to repay is super important because that is all that information about the actual money that you make, maybe potentially assets that you have in addition to securitize or just to hold in case of a rainy day to make additional funds, and trends in your bank account balance. And I'm sure we'll talk plenty about Cashflow underwriting and how useful that is in adding to that ability to repay suite, and doing so at a cash and friction efficient basis, so that you really don't have to be asking for that much more from the consumers or spending that much more out of your own operations budget. But then the third piece of the product level underwriting, what we call second order risk, which is what is the risk that the product that you're putting somebody into on its own will make someone default? And I think this is hard to separate from the first two, because it seems like, well, obviously somebody who has a lower willingness or ability to repay is going to be put in that position. But what I'm trying to say here is that actually, if you hold those first two constant, the product really matters. And all those stats I was going through earlier in those Alt-A loans, those are really emblematic of the problem leading up to the financial crisis. Was banks were putting borrowers into loans that were setting them up to fail. That their prior credit history was not a reliable barometer or predictor of that, because these product terms were like nothing else that they'd ever seen before in their consumer credit history. So they've been able to repay all of their credit cards and personal loans and car loans because they understood what those terms were, and those terms didn't all of a sudden like change overnight. When all of those Alt-A loans contained all of those provisions I just mentioned about negative amortization, interest-only payments, and adjustable rate loans, that in and of itself created a product that created a default crisis in and of itself. And even in quote unquote more straightforward or safer credit products, you can still have second order default risk if you just give somebody too much money. Or if you just have a monthly payment that's too high for them to be able to afford. So it's something that's really important for lenders to consider. And I think the future of credit underwriting is a credit score or a set of credit variables and attributes that almost adjust to the product in a sliding scale. So, you want to offer this different product, either a longer term loan, a higher dollar loan, a higher interest loan, whatever it is, deferred interest, amortizing it in a different structure. How does that change the likelihood of default? And so a 700 can become a 620 if you give them the wrong product, or a 620 could become a 700 if you give them the right product. And that's something that I think the best lenders have figured out a way to do, and to do quickly and systematically and efficiently. And other lenders are still struggling with.
I think you're exactly right. And that's exactly where I want to take this conversation, right, is second order risk. Because as you said, willingness to pay, we have actually really good data on that. We have good modeling. We have good scores that really tell us a lot about that. Ability to pay, that's everything having to do with getting more programmatic access to bank transaction data. A lot of your report actually talks a lot in detail about that and how that can be a really helpful way to balance out some of the challenges of over-reliance on credit reports and credit scores. But it's this second order risk area that I really do want to dig into, because the theme of this episode, broadly speaking, is context, right? One of the things we sort of, I think, have lost a bit of track of over the years in lending is the ability to take a really contextual look at borrowers. And as I was describing before, that's what really good, careful lending that produces great results, that's what it does essentially, is it drills into the specific context to try to understand, what are the things we think we know about this borrower, and how might those assumptions about their ability to pay, their willingness to pay, how might those things change depending on some of these kind of hidden or secondary factors that are harder to assess, but really do have an impact on performance, right? So you talked about product risk, which is a great one, right? And obviously, like adjustable rate mortgages are great. There's the scene in The Big Short where they're talking to dancers about the multiple homes that they own. And it's like, you're not going to be able to afford your mortgage when your teaser rate expires. Like, that was just not a concept that borrowers understood. And clearly it wasn't a concept that lenders understood from a performance perspective. And that same thing applies to a lot of areas, I think, within financial services, right? I mean, one of the things fintech has done, and you've worked at companies that have been a part of this, is really innovate on product structure, right? Like, here's a different way to loan someone money. Here's a pay in four loan. Here is a payment or a loan that takes a new form of collateral into consideration. Like, we are very good in fintech at fiddling with and changing and adjusting product structure to better solve for customer needs. But to your point, that's a really hard one to express in traditional credit bureaus and in traditional credit scores. I mean, we can talk about buy now, pay later just for a second here, because I think it's interesting, and you have a background in this space. I mean, there's a whole kind of wide-ranging debate around why buy now, pay later lenders aren't, for the most part, furnishing pay in for BNPL data to the credit bureaus. There's a lot of different angles you can take that discussion, but one of the ones that's
how much
really
time you got,
to
Alex?
me,
I think we might be
seriously. We could do 3 hours on that, no problem. But one of the areas that's interesting to me in that discussion is essentially this question of how do you incorporate this data into the traditional credit file, right? Because a pay in for installment loan is kind of like a traditional installment loan, but also not. And it's kind of like a revolving credit line, but it's also not. And so it just doesn't cleanly fit structurally into this data. And the thing, and I've written about this multiple times in the newsletter, the problem is fintech doesn't stop coming up with new product structures and new ways of doing this. And so it makes me wonder, Martin, about like what broader things do we need to think about from an infrastructure perspective to kind of solve for this problem, because the lending ecosystem is just more complex and there's more of that second order risk sort of lurking everywhere than there was 50 years ago.
Yeah, you're totally right. And by the way, on the BNPL credit furnishing thing, the short answer is, right, there's two reasons why the take up has been very low, and I continue to be pretty bearish in the long-term prospects of it, despite like whatever you see in the Wall Street Journal where they keep saying it's happening.
Don't get me started, Martin.
Yeah, okay. I won't go down that rabbit hole. But one reason is the product construct, as you mentioned, it being very different from, the traditional product. So Metro 2, which is the formatting structure needed for the big three credit bureaus, that's based on monthly furnishing. BNPL, the pay in for is every 2 weeks. It's based on relatively low frequency of, credit products. BNPL consumers can take out several dozen in a year. And because of those, right, to your point, no one really knows, should we furnish these as individual installment loans? That's the cleanest way operationally, but then you can confuse the models and have to think that these are like a bunch of personal loans, like lending club loans, where they're not the same thing, and it takes years for the model to learn the difference. Or do you put a thumb on the model and say, actually, no, you need to treat these differently? But FICO doesn't like doing that, right? Like they don't like, telling the model what to think. They like letting it do its own thinking. So that's one reason. But then the second reason, which is related to the end of what I was saying in the first, is that there's this concern that if you furnish them, and even if you do all the research and decide you found the right way to do it and everybody gets it right from a, dotting I's and crossing T's perspective, there's a concern in the industry that that consumers who use the product a lot could see their credit scores go down, even if they're repaying them. Right. I think, if they don't repay them, their score should go down. That makes sense. Everybody kind of agrees on that. That's the way, that's, kind of how it works. But I think everybody also agrees that in general, if you're paying off your loans, you should see it go up. But that's not how FICO works. It's not built to reward behaviors. It's built to just predict the future based on the past. And if it is the case that using BNPL 20 times a year is actually correlated with risky outcomes for reasons that can make sense or not make sense, because it doesn't have to make sense. It's a black box model. The score will go down. And I'm not saying that will happen necessarily. I'm saying in this hypothetical, that is what could happen. And nobody really knows ahead of time how that's going to work. And so you can test it, but it's not the same as when you put it into production. And if you put it into production, you have to kind of cross your fingers for a little while if you're one of these companies, hoping that won't be the case, because the headlines, speaking of the journal, will not be kind to you if it turns out that even 30% of on-time repayers are seeing a meaningful drop in their credit score. Doesn't have to be everybody, right? Just a meaningful percentage. So I think that piece, it's a telling story. It's an important story of where the market is going, in the sense that credit products don't look like they used to. Mm-hmm. Therefore, the models don't necessarily know how to treat them the way they used to. Mm-hmm. Mm-hmm. Consumers are afraid of what could happen. The lenders are afraid of what could happen to this. And therefore, there's the general tendency is to pull back, especially with a product like BNPL, where the lender already has your payment information from the down payment, and therefore can continue to keep charging that payment method until they get a successful payment. So they don't really need the credit bureau furnishing as this stick or carrot to dangle over the consumer in the way that traditional lenders would have to.
No, I mean, I think all of that is exactly right. And I think that, it's one of those areas where it is kind of telling about the future, right? Because, BNPL is one example, but there are lots of other examples. And it kind of speaks to the fact that, and you mentioned kind of sophisticated lenders already really understand kind of second order risks and do a good job kind of optimizing for them in order to get the performance they need for their portfolio. The challenge is that as more of this becomes fractured, right? Like, let's say, and I'm bearish as well, but like, let's say that BNPL lenders don't furnish a lot of pay in for data anytime soon to the bureaus, which I don't think they will. And let's say that, we continue to innovate on the consumer lending side, and there's lots of additional new product structures that are kind of novel or a little bit different that sit outside of the traditional kind of credit bureau landscape. It really puts lenders in a tough position, right? Because you have to assume that your borrowers are taking advantage of everything that they can out in the market to solve their needs, right? Like, borrowers are independent agents that will go out and do what they need to do to solve their own problems. And just because what they're doing doesn't show up in the credit file or doesn't show up in some of the traditional data that you're looking at doesn't mean that they're not doing it. And furthermore, you don't necessarily always know how to interpret that data, right? And so one of the things I don't know, I get concerned about as you sort of pull on this thread is that it starts to create a lot more of a sort of have and have not dynamic in lending. And this kind of ties back to where credit bureaus and where traditional credit scores are really useful. They do have the effect of kind of somewhat leveling the playing field, right? And like, everyone gets access to pretty sophisticated modeling and pretty good data to help them with their credit analysis. But as we talk about like data not fitting neatly into these categories like it used to, it really advantages someone like a Capital One who's very sophisticated about this and has, I've seen it with my own eyes. They have like hundreds of people sitting on like floors of their building in McLean, Virginia, doing nothing but figuring about new ways to slice attributes and new ways to understand consumer behavior. Like that against a community bank, for example, that is trying to make similar quality decisions. Capital One can adjust to some of these things and they can get access to this data in different ways, or they can adjust their own internal models to adapt to some of these problems. Smaller lenders are going to really struggle to do that. And so I guess putting this back as a question to you, Martin, how do you think that sort of divergence between different parts of the market resolves itself over time? Because that's something that I think we're going to continue to see until we get better infrastructure or better options that can help, again, kind of level that playing field.
Yeah, I think, from a product perspective, decisioning engine platforms are going to be really useful for the smaller community banks. I mean, even for large lenders, but especially the smaller lenders that don't have the same R&D budget and don't have the same budget for either data science or for product and engineering. If you hook up with a decisioning engine, you immediately have a platform that has a whole bunch of vendors that it has relationships with. You immediately have access to all of those vendors. And so you immediately can start testing into those scores and attributes from all those vendors and implementing them at bulk cost, even though you're a pretty small fish, because the decisioning engine platform gets that bulk rate and they pass that rate on to you.
They're kind of aggregating on your behalf.
I saw that firsthand when I was on the risk team at a very early stage startup in 2017 and 2018, when we were an early client, of some of these, decisioning engine vendors. And it really allowed us to be able to grow very quickly, both actually from a fraud underwriting perspective first, because that was kind of where that use case was first built out, and fraud was rampant then, and it still is now, especially for early stage companies. The fraudsters always want to hit the young guys. Right. But then also from a credit perspective, which has been built out a lot more in the ensuing years. And that allows that community bank that you were, hypothetical community bank you were mentioning earlier, to stand up a credit product and be able to use those cutting edge credit and fraud variables and attributes and techniques, but do it in a cost efficient way without any overhead. If they don't like the score, they can kind of turn it off immediately. They don't have to sign on this 2-year contract and be stuck with this albatross.
Right. Absolutely. So, digging more into the second order risk, because I think this is a really interesting area. We've talked about product. Another one that I want to get your take on real quick is more, I guess, what I would call kind of institution level risk. And what I mean by that is, obviously every lender above a certain size builds their own proprietary scoring model and underwriting model, right? And credit data is an input into that model. Yes. Traditional credit scores are an input into that model, yes. But they tune it for their
even though no one
portfolio.
Wants to say that, right?
No. Yeah, no one will ever admit that. But like, they always take that stuff in. It's always an input, but they tune it, right? And this is very understandable, right? Because every lender, and even divisions within a lender, right? Like the credit card group versus the auto lending group versus whatever, they all want to build their own models because what they know is for our specific segment of the market, credit scores are a generalized model for the entire market. For our specific part of the market, if we take a slightly different approach to modeling this behavior and we look at slightly different data sources and we have slightly different attributes, we can outperform those standardized models. We can price risk better. We can say yes to consumers that other lenders might think are risky that we know we can price effectively and say yes to. And so everyone builds their own models, both on an institution level as well as on an individual line of business level. The other thing that I think takes into consideration that's really important is like the second order risk in this context is it also considers the relationship that the lender has with the customer, right? And one of the things that is, I think, very frustrating to model is, why does lender A outperform lender B? When like on the surface, everything is very similar. Well, one of the things you have to always think about is, and I saw this a lot when I kind of dug into the subprime lending world over the years, when consumers come under stress, they have a decision-making framework in their head for how they're going to prioritize their repayments, right? Auto lending and subprime is a good example. If you're the provider that helps someone buy their truck and they need their truck to go to work and to do work, they are going to pay you back. They might not pay a lot of other people back, but they will pay you back, right? Based on the value that your relationship provides to them and their livelihood. And like that stuff it's a second order risk because it's hard to quantify. It's different per institution. And again, it requires like a much more nuanced approach to credit decisioning than what you can express in like traditional credit data or traditional model. Can you give us a little insight based on your experience into like how that works?
So you're referring to this concept of payment hierarchy, and credit risk managers are very familiar with this. And I think CEOs should probably become more familiar with it if they're not, which is the idea of if your customer has a bunch of debts to repay and just obligations, they don't have to be there's a bunch of financial obligations. Everything's going fine with their job and with their healthcare and whatever, then they can pay them all back. But if for whatever reason there's a shock. If they can't pay any of them back, okay, well then it doesn't matter. There's no one's getting repaid. But usually it's something in the middle where they can choose which ones they want to decide to repay and at what, what intervals. Mm-hmm. And every lender wants to do whatever they can to move up the payment hierarchy. I mean, that's just only natural. So there are some things that lenders will do, especially when it comes to getting on auto pay, that will improve that likelihood of payment hierarchy. And that's why you see a lot of installment lenders offering auto pay discounts because they want to get as many consumers on that so that they're not choosing to repay, that it's automatically coming out of their bank account. Another one is very popular is due date adjustments, where the consumer can choose their either after the point of origination can call in or talk to a chatbot and say, I'd like to change my due date from the 2nd to the 10th because this is, I get paid on the 9th or something like that. Originally, finance, the CFOs wouldn't like that because they're saying, wait, you're giving them an interest-free loan for a couple of days to move back their due date. And I would have to say, no, trust me, you want to do this because that'll make it likely to get repaid. It pays for itself in dividends, even if you are essentially giving a bit of a float by extending that first month. Some lenders are also offering this at the point of origination during the application process, saying, okay, how much would you like to borrow? How much would you, when would you like to repay? And then working out the details of that amortization right off the bat so that you can present that offer and present that TILA compliant screen and the Schumer box and everything, that is working with what the consumer wants, which is to be paid on a certain day and therefore make payments on a certain day. So it helps the consumer. It also helps the lender. It's kind of a win-win for everybody. The interesting thing about the products, which product get paid first, is that the only study that I have seen that has looked to measure this on a product versus product level is a TransUnion study from a few years back that looked at mortgages, credit cards, auto loans, and personal loans. And the expectation was, well, obviously, mortgages and auto loans will be at the top of the payment hierarchy because, of course, like who want to lose their house and their car? It's a secured loan, et cetera, et cetera. Credit cards will be next because even though it's unsecured, you want to continue to have the spending functionality. And then personal loans will be last by a long shot. Like you wouldn't even see them at the finish line because the money's at the door on day one. Usually people don't use personal lenders that often. So they don't, what's the repeat usage component? Why does it matter? Like, essentially what's the point of even paying these guys at all? But that's not what the study found, right? And so the study found that actually personal loans were at the top of the payment hierarchy. And I have presented this to risk managers and finance folks and tech folks dozens of times over the last 8 years since it's come out. Everybody says there's got to be something wrong with that. I don't believe it. And I say, okay, show me a better study that refutes this study. And no one's ever been able to do it. I understand that theoretically it makes no sense. Well, that's not true. It makes no sense if you consider that the only reason people are paying back is because of the direct consequences of non-payment with that loan. However, if you consider the fact that consumers have been so trained on increasing their FICO score at all costs, which is a big part of what my paper was about, then it's not so crazy because personal loans monthly payment amounts are usually pretty small, whereas mortgage and car loan payments are usually very large in comparison. So if you only have so much money going around, a lot of people think, well, why not make a full payment on my personal loan? At least that loan won't be delinquent. I've heard that I can actually have a pretty long time to get right on my mortgage before any foreclosure or, really bad things start happening there. And auto loans, same thing, although it's a little shorter leash. But if I'm thinking about my credit score, I know it's going to get damaged from not paying all these off on time. But if I just make partial payments on my auto loan and my mortgage, they're going to keep rolling. And from a consumer credit perspective, from a credit score perspective, they're all considered non-payment. So why not just make a good payment on my personal loan? Now, I know that's a roundabout way of answering your question, but I think it goes to the heart of the fact that decisions that consumers make are not always as cut and dry as we, in the risk office might think that they would be.
I couldn't agree more. And I think, you make a mistake if you assume that you understand how consumers are going to make those decisions. And you also make a mistake when you assume, well, this is either the logical thing to do or this is what I would do, because both of those are traps that will lead you into bad assumptions and ultimately bad assumptions built into models that make these decisions. You touched on something there that I want to circle back around to, which is we've talked about the risks of sort of over standardizing on one way of looking at the world from a lender perspective. We haven't talked as much, although your report does a great job delving into this, about the risks of consumers over standardizing on one way of thinking about this, right? And so you talked about the fact that sort of credit score optimization has become a bit of a cultural practice in the US in a way that would have been pretty strange, I think, to people living in like the 1980s, right? Today it's very, very common for consumers to seek out and to try to sort of organize their lives and their behaviors around information that tells them how to maintain a good score. And I have always kind of thought about this as, just a function of, if lenders are telling me this is how we make decisions, and we just kind of walked through why lenders shouldn't over standardize on one way of making decisions. But if that's what's being communicated to borrowers, a very logical incentive the borrowers then have is to protect that number and to make sure that that number goes up and doesn't go down because it is very economically consequential to them. Can you kind of talk us through the sort of high-level consumer impacts of over standardizing on a number and kind of some of the emergent behaviors that have come out of that? Because I think that's the other thing that as maybe we move towards a more contextual approach to understanding creditworthiness, we hopefully will see change a bit.
So this is the big change that's happened in the market since 2008. There have been a lot of positive developments in terms of maintaining the safety and soundness of the system and maintaining better consumer outcomes. And that's why mortgage losses continue to be really, really low, and they have been for a long time. However, in 2005, 2006, 2007, this idea of like score gamification, score maximization, optimization, whatever term you want to use, it didn't really exist. Yes, it was always understood that there were certain things you needed to do to increase your credit score. Mm-hmm. If you ask FICO, they would say, oh, just like be a normal consumer and pay your bills back on time. But there was always this understanding that there was a bit of a gray area where there was these behaviors that were not exactly as cut and dry as paying back your loan on time, that were a little bit more gamifiable, but no one really codified them. It wasn't something that made the rounds on the internet. It wasn't something that, that young adults are kind of grown up learning. That has really changed since 2010, and really since, like, let's say 2015, 2016, as social media has continued to become more and more ingrained on hacks in all aspects of life. Credit score hacking has just become, as one started off as this very kind of niche, back corners of the internet to front and center. And when I say front and center, I mean front and center. Literally a few weeks ago, a TikTok video was shared by someone who's not like a massive influencer. I mean, he has a few thousand followers, but he's not like, one of these mega millions of followers. And he walked viewers through how to upload their credit report to ChatGPT to generate letters, automatically generate letters that would send out disputes to all the credit bureaus and all of their creditors, saying, this delinquent account wasn't mine. I demand under this law, and it has the names of all the laws, the consumer protection laws, that you remove this trade line. Has 2 million views. It got 2 million views within 2 weeks of going live. That is the kind of thing that lenders are up against right now, which is that AI is allowing consumers to automate and to mass herd into certain behaviors that used to require a lot of manual work and a lot of manual friction. So you used to know that, keeping your utilization ratio low is good for your credit score. I have to call my credit card company and ask them to increase my credit limit. Like, I don't want to do that. But now you can just send an AI agent to do that and on your behalf. I know that becoming an authorized user on someone else's credit card can be helpful, although that's becoming a little less so, but people think it's still really important. Now you can just pay companies to do that for you. All of these hacks that are very removed from intrinsic creditworthiness have now all of a sudden come front and center into the minds of 1 to really 3 generations of adults that have come of age in the internet. We're not just talking about, Gen Z or Gen Alpha.
No.
There's certainly a lot of folks in older generations who are taking advantage of these as well. So consumer friction used to really be a point that lenders could sit back and rely on, that, not every consumer is going to do this behavior. Now They might all do this behavior overnight.
Yeah. Well, so let's wrap up by talking a little bit about what I would sort of classify as the sort of AI laziness problem, right? Because I think in a lot of ways, what we've been talking about is this idea that there's kind of a right way to do things and a wrong way to do things. And, as it relates to making credit decisions, as we talked about, like, there is a very nuanced, very detailed, very rigorous approach to evaluating someone from credit that really hasn't changed, honestly. Like, there's nothing really that new about making a credit decision. However, everyone's incentives, businesses and consumers, is, in the absence of, a reason not to take a shortcut, right? And I think that a lot of what's happened, both in terms of lenders over-standardizing on the use of credit scores and traditional credit data, and consumers sort of maybe becoming overly reliant or overly interested in hacks or shortcuts, a way to get around the hard work of building your credit score the way that FICO always told you to, which was just pay back your loans on time, act responsibly. Like that's the behavior we want to see. On both sides, we've sort of seen a degradation of that and a move towards. I wish I could come up with a better word to describe it than laziness, but I really think in a lot of ways that's what it is, right? Is this like, let's take the shortcut, let's do the easier thing here. And as you just laid out, AI has the potential to make all of this much, much worse, right? Because, and we'll just use the consumer example you were just talking through as the example. There used to be some friction in trying to game the system. AI removes a lot of that friction, or can do that kind of friction-filled steps on your behalf instantly, right? I mean, calling up every one of your creditors and calling up each of the credit bureaus and disputing transactions, that just took too much time for anyone but the most motivated individual to do. Now with ChatGPT, not only can it analyze all of that and come up with a plan for you, but with like agentic capabilities, it can take action on your behalf. It can send emails. It can actually call phone numbers and talk as if it's you or as if it's a human being talking, representing you. And so it really lowers the barriers to this. The flip side, which you didn't talk as much about in your report, but I do want to talk a little bit about on this podcast, is I also think AI, and we'll use AI to refer specifically to like generative AI, large language models, agentic workflows, that kind of stuff. I think it also has the potential to make more rigorous credit assessments more efficient, right? Or more effective. And, we talked before about this trade-off between making the best decision and making an efficient decision. Well, I mean, if you can, as a lender, apply large language models or apply AI to go out and get, an income statement and parse that income statement and give you an attribute for revenue, but not just one attribute, give it to you in 4 different ways, depending on how you want to calculate revenue. Like that is a huge time saver for making a good decision. So I guess the question I'm trying to frame to you is, do you envision AI and sort of cutting edge technology that we're seeing now being applied to sort of continue taking us down this path of laziness, or potentially being applied to sort of help us more efficiently do things that we've known we should be doing for a while, but have just been like too time consuming or too manual or too difficult? Do you have sort of an optimism versus pessimism viewpoint on this? I can represent whatever side of it you want to take. If you're more of an optimist or pessimist.
Good timing. I mean, and I trust that you were going to ask this either way, but I actually happened to just publish a piece on this exact topic yesterday. And the idea is that from a banker's perspective, you should not be taking a one-size-fits-all approach to AI in 2025. It should be very context-specific. In the situations where it should be in situations where you're dealing with consumer behavior that can be mass herded and automated in a way that used to be disparate and require a lot of friction, you should be very afraid of it. Like that example I just gave about the the credit disputes. Another one that I think I would be very afraid of is if you're offering balance transfers and promo rates and stuff like that. And it used to be that like, well, most of the people who take this end up staying with us and then revolving. Like, don't be so sure anymore, because now it's pretty easy for consumers to hop, balance to balance using an agent and basically pay zero interest, forever on a balance that's not even really declining that much. So that's something where lenders should no longer rest on their laurels that, well, consumer friction / inertia will save the day. It absolutely will not. And it's showing already. In the middle ground of use cases where you're getting bombarded with sales pitches for AI and you're wondering, is this really worth it? I would ask, is this product that they're offering something that's actually existed for a long time and they're just using new language, or is it actually a brand new product? And an example I give in the paper or the article with Open Banker is underwriting has been using AI, I say that in quotes, for 40 years because machine learning techniques, which are a form of artificial intelligence, have been around since the 1980s. And so I would be very wary of anyone who's just offering this new credit underwriting product purely because it is AI, and not really touting any other benefits. Because there are a lot of benefits of using a machine learning model. And if you're not using one, you probably should be using one. But that's a really 0 to 1 problem. Once you've got a machine learning problem, every other machine learning model you put is going to give you incremental benefit, but it's not step function on top of that. Doesn't matter how many fancy bells and whistles they put on top of that. It's all about the actual underlying data that you're putting into it, like cash flow data, like alternative data that's not feeding from a traditional credit bureau. And then lastly, if you're talking about data, if you're talking about AI opportunities in parts of your business that have never benefited from automation and that are dealing with a lot of bottlenecks, you really should be looking into it and finding ways to embrace it, but still keeping the humans in charge at the end of the day. Operational processes such as reviewing disputes, reviewing customer complaints. A lot of times big banks don't have the time or the effort to review every one of those one at a time, and they review them in batch. Well, if you can use an AI software that could review each of those and give you summaries of every single complaint or every single dispute or every single error that was happening on any of your screens, then you could have people making more balanced, holistic decisions that weigh into consideration every single piece of data that you have rather than just a random sample.
Yeah, no, I mean, I think that's extremely well put. And I'm glad that you will drop the link to the article you wrote in the show notes. I mean, I think that's such a good way of articulating the differences between different ways to think about AI if you're a lender, because it's just going to accelerate things, right? And It can accelerate things in a positive way, in a negative way. And so in keeping with the theme of this episode, having a contextual approach to thinking about how to apply it, where to be worried about it, where to be leaning into it, I think that's the exact right way to think. Martin, we could keep you for a lot longer and ask you more questions, but out of respect for your time, let's end there. Martin Kleinbard, thank you so much for joining me.
Thanks so much, Alex.